Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. Our show today is brought to you by ShareFile. Let me ask you this. Do you send files to folks, sometimes too big to get through to them? Do you collaborate with others? Do you need some secure way for your information and your files? Sure you do. We found one. We use ShareFile. Learn more at sharefile.com. Well, today we're going to talk about retail and retail real estate. Look, retail is a big part of our economy, right? Consumer spending drives the U.S. in a big way. And retail real estate is a big part of commercial real estate world around the U.S. And, it's been an interesting time. Everybody thought with the dot-coms that the retail was dead for a while, came back. Kind of what people think about office now. It's dead, never come back, right? Retail did come back and came back pretty strong, right, in most markets. But we still have some shopping centers in some areas that are not doing well, and then we also have some small box issues with some of those tenants around the country. But what's happening where you are? What's happening around the country? What should we expect moving forward? Well, please welcome my guest. It's Xander Snyder. He's senior commercial real estate economist with First American Economics, which is part of First American Title. Xander, good to see you, sir.
Good to see you as well, Michael. Thanks for having me on.
Well, thank you. And to get us started, when you look at the performance of retail properties around the country, kind of overall, what do you see? Have these rising interest rates that rose so fast caused any issues? How's consumer spending? How are these properties doing okay out there, generally speaking?
I think the best way to frame sort of the state of the retail market right now is to look at the supply and demand fundamentals of the retail asset class itself, and then separately to consider trends in consumer spending. So interest rates, sure, it's affected all commercial real estate to one degree or another because cost of borrowing impacts everything we do in this industry. But there hasn't been a lot of new supply of retail space added to the market. There's been a fair amount of demolitions and space removed from the market in order to either convert it or possibly for ground up development. Just because, as you mentioned, some shopping malls in certain areas that perhaps are a little difficult to get to, not centrally located, have been struggling. And that's been the case since pre-pandemic. On the consumer spending side, I'd say that the consumer still remains relatively strong. I think that there's less money being spent on retail sales than a lot of people in the market. So I'd be happy to get into that in the course of our conversation.
Yeah, well, that sounds good because if consumers aren't spending, then the result's going to be retail real estate's not performing well, right?
Yeah, exactly. So the way to think about this is there's this retail sales report. Retail sales is a portion of all consumer spending in the economy. Retail sales growth has generally been reported on as being quite positive, and if you look at it in nominal terms, which is how the retail sales report comes out, it's not inflation adjusted, then it looks really good. And then you get headlines about consumers spending a lot and growth is positive, so on and so forth. But the greatest challenge that consumers have faced over the course of the last several years has been inflation. And when you adjust the nominal growth in retail sales by the inflation rate, by just CPI, you actually get to a negative or stagnating retail sales growth figure for most of this year. Kind of turned into negative territory in the first quarter and has remained either negative or around zero since then. So I think in real inflation adjusted terms, people actually aren't spending as much at retail locations compared to a year ago.
Yeah, and that makes sense because prices have gone up so much. Some folks are having to cut back or just naturally going to cut back, right? And how about
Exactly.
this sentiment and consumer sentiment? Yeah, what do we think about the world right now?
Yeah. Well, it seems ambiguous. I mean, consumer sentiment has not been great over the last couple of years, just because prices are higher. I don't think that that's necessarily going to change as inflation decelerates, because inflation still means growth in prices. It doesn't mean deflation where prices are going down. But in terms of it, there's often a disconnect between what consumers feel and the dollars and cents underlying their ability to spend. And I think what's interesting about looking at real uh, inflation adjusted retail sales is it gives you a sense of how much actually getting spent. And if you look at trends in, say, for example, credit card debt, then you can see the consumers are actually racking up a lot more debt over the course of the last several quarters. And this is true in both nominal and real terms. And as that has been taking place, delinquency rates on credit cards have been going up. So, uh, how much longer can that continue at these higher interest rates when consumers need to begin servicing these larger debts? That's why I think that consumers are facing headwinds heading into next year, even though it's not getting reported on quite as much.
Yeah. Well, that's interesting, and it makes sense because these interest rates on these credit cards are high to start with, and now they're crazy high, and it's got to cause problems, especially if the job market softens a little, right?
Right, exactly. And that is what we've seen over the last 2 years or so, a
Mhm.
gradual softening in the labor market. It's not soft, it's just softer than it was, heading in enough of the right direction for the Fed to feel confident about that 50 basis point rate cut we just got.
Yeah, yeah. I was doing the Snoopy dance on that one. Like, uh, I really like that, and it's interesting as brokers that we sell commercial properties of all types here, and we've seen activity on all of our listings almost jump, and a lot more sellers too ready to say, all right, I think it's okay now how to sell. So I expect that's going to pick up transaction volume for everyone in next year. What I certainly hope so. But let's go back to kind of retail performance right now, Xander. What's happening with occupancy and rates? How's retail performing right now?
Right. So the supply demand fundamentals of the retail commercial real estate asset class itself is quite positive. As I mentioned a moment ago, there's just not a lot of new space available. A lot of space has been removed from the market. And at least to date, people are still spending money, even if in real terms, maybe it's stagnating a bit. But if you look at vacancy rates for different types of retail, so for example, malls versus strip centers versus everything else, most retail vacancy rates are quite low, sort of between 2 and 5.5, 5.5%, which is lower than a lot of other asset classes. The exception is malls. Shopping malls, vacancy rates for shopping malls have been increasing steadily since about 2017. So again, sort of a pre-pandemic trend, but typically there's not a lot of space available, and that means that tenants don't have a lot of options. So the impact on that on retail prices, for example, is even though they have declined through this adjustment over the last couple of years, retail property prices haven't declined by as much. There's been a little bit of a floor place because of that lack of space available.
Yeah, that makes sense. I'm headquartered in Atlanta, and retail rents here have just been really strong. The retail tenants that we rep, we're really having trouble finding the right locations, and then on the landlords we rep, we're keeping the buildings full.
Great news. I'm glad
Yeah.
to hear it.
Yeah. What about the future, though? Xander, you mentioned that maybe there's some headwinds for consumer spending and sentiment, but as you also mentioned, kind of a lack of new supply in most every market. What would you expect for performance moving forward for retail properties?
I think there could be some slight pressure on rents, or at least maybe not downward pressure, but just a limitation to how much more rents can be increased for new leases, right? Because most retail leases are multi-year and they have step-ups built into them. So that's positive from the perspective of you have a little bit of protection if you're an investor looking forward. But I do think that as consumers run into some of these headwinds we've been talking about, retail sales will probably continue to stagnate, might decline a little bit in real terms, and that'll limit how much is being spent at retail locations. So, how much that those retail tenants can sell, which obviously impacts how much rent they can afford to pay. But I think my sense is the overwhelming lack of supply of retail space right now, which is not just something that's happened recently. I mean, this is the result of a decade long trend of people gradually thinking that, oh, the retail sector is doomed, so maybe we won't build too much more new space of it. I think that that's essentially that's going to largely overpower the slowdown in consumer spending that I think will probably begin to happen next year. So I think that's the larger trend to look for is a lack of space And at least for certain types of retail tenants, for example, experiential tenants. So businesses, places you need to go to actually buy the good or service that you're acquiring in the business, right? You need to be there. You can't buy getting your nails done on Amazon, for example.
Mhm.
Those locations have shown to be a little bit more resilient coming out of the pandemic because people have wanted to get out and spend money. And I think that experiential locations will continue to be more resilient than other types of retail locations when consumers have less money to spend.
Yeah. Yeah, that's a good point. And I also like your point about new supply because, a lot of us may think that, new supply kind of curtailed in the last couple of years as interest rates spiked up rapidly. And they have. And some of that new supply is going to help office and industrial in the next few years as the current properties under construction hit the market. But to your point, I guess retail, it's the dot bomb, right? The retail is going to be dead forever. I guess the new supply has been lower than historic. I remember a lot of the guys saying, that retail was kind of under demolished, right?
Yeah, I hadn't heard that line. That's funny. Yeah, now it's not. There's plenty of space being removed
Yeah.
to either convert or to build ground up because there's better uses for a lot of that space, or at least there was. But over time, that accumulates, and you don't have a lot of retail space to go around.
Yeah, yeah, and retail is a fascinating property type. It's even if the use has gone down, it's usually good real estate, right? It's usually maybe main and main. It's flat. It's got utilities. It's got visibility. So a lot of change in use. I think retail is a fascinating sector. We love selling retail properties at our firm. But hey, at First American Title, you guys see transaction volume a lot around the country. What do you see for retail property transaction volume the last few years? Do you see any trend happening yet with transactions?
Yes, we are very clearly a volume business. So it's something we spend a lot of time looking at.
Mm.
I think that over the last couple of years, retail transaction volume has fallen like most other asset classes because interest rates have gone up and buyers have been limited in what they can pay. And I mean, to your point about sellers a moment ago, they've kind of been hesitant because they can't get the price that they want, and now that might be beginning to change a little bit as rates come down and buyers can afford to pay more. I do think that the lack of new space will probably limit some transaction volume to a certain degree, just because there hasn't been a lot of new additions. But I certainly think that as rates come down, we're likely to see transaction volume for all asset classes, increase, and retail will certainly be part of that trend.
Yeah, we're seeing it as brokers. We're seeing activity really pick up, and buyers more comfortable. They can trust their underwriting and lenders, and also some sellers that realize, to your point, that the interest rates are a little bit lower, so maybe the buyers can stretch a little bit more. But also, we're seeing sellers like, we're back at more historic, normal rates. So values were a little inflated from the free money, and we're back to more realistic values. If I'm taking profit, I'm taking profit. Or if I just need to get out, I need to get out. So you expect transaction volume to improve next year, and is that what I'm hearing?
Yeah, I'm
I just
sure
want to hear
everyone's
it
heard of this.
again. I just want to hear it again.
Things are getting better. Yeah, no, I just got back from a tour of the Midwest, and my opening line now is I've been flying all over delivering bad news for 2 years. It feels good to actually be able to bring some good news to folks. I do think that you've probably heard, stay alive until 25. We're almost there. The phrase I'm using now is stay in the mix until 26 because if it rhymes, it'll catch on, right? But I mean, what I mean by that is I think the more full recovery occurs next year, and money begins to be made more in earnest in 26, which is really what people are looking at. But coming back to your question about transaction volume with retail specifically, I do think that there might be some geographic variation in terms of where you see volume pick up more. For example, if you look at retail property prices over time, kind of broken out by downtown urban locations versus suburban locations that are walkable versus suburban locations that are less walkable. Prices have only really declined over the last 5 years for those highly walkable CBD locations, the urban locations. So that's kind of the story of, fewer people are going into work and office in the urban core and maybe spending less money in the immediate vicinity, which has impacted property prices there. But as demand has shifted out of the urban core, people are spending more money closer where they live. And I keep hearing uh, about the bullishness, I guess no pun intended, or maybe the pun's intended, about mixed use real estate that's either ground up or kind of being revitalized because people want to spend where they live, where they work as much as possible. And if you look at retail property prices for those sorts of locations, the car dependent suburban locations, they've actually been quite resilient and increased over the course of the last 5 years compared to pre pandemic.
Yeah. Well, you're talking about bulls. So if anybody asks me what the market's like, I don't know if my cameraman can zoom in, but when I have my clothes made, they say, "Michael, put your name in there." I'm like, you know what? I think I can remember my name. Let's put something more interesting. So inside of my jacket, it says bull market. So if you ask me what the market's like, it's a bull market. How do you like that? Um, Xander, when you think about the retail market and you talk about, the property types, think about geographic locations, where do you think there's some opportunities either for investors or developers or maybe tenants? Where are some opportunities today?
I think that, let's see, there are, it might be actually a little bit more challenging for tenants right now because there's so little space. So that might not so much be an opportunity, but if you're coming at it from the other side of the table, then there's an opportunity to get solid leasing spreads over pre-existing tenants because there's probably some gap to market right now based on the limited availability of space. I think that there's probably not a lot of demand yet for new retail construction, in part because rates still are high. I mean, they're coming down, but the cost of financing construction is still uh, much higher than it was, and there's a limited availability of construction financing, and costs of inputs to construction materials, so on and so forth, are much higher than they were. So I actually think that that will continue to limit the availability of space, but that's good for investors and owners because it means if you own a good retail property, then you have a little slice of something that there's not too much to go around for. So I think the opportunities really sit in well located central real locations where people need to go in and visit the locations to actually buy stuff. So I think if you're an investor and you own experiential retail locations, for the most part, there are maybe a few exceptions to those types of experiences, but I think you're well positioned going into the future, and you'll be increasingly fighting over fewer and fewer buildings to buy.
Yeah, yeah, that's a good point. That's certainly what we see in Metro Atlanta. Xander, let's talk about valuations, cap rates. Kind of, what are some trends you're seeing there on retail property values?
Well, it seems like cap rates are stabilizing for retail properties, which is good news. I love to see that. And maybe by the time we get the full third quarter data out in a couple of weeks, we'll actually see a slight decline in cap rates for retail properties. In part because rents have continued to move positive, and uh, at the same time, prices have kind of leveled out for retail properties. So, I mean, just the way the math works out is it seems like we're at an inflection point. And I think that that's pretty exciting because cap rates for pretty much all asset classes have been increasing now for the last 2.5 years. Retail is no exception. So if you look at a chart, by the way, for cap rates over the last 25 years, they've typically been going down, save for that time sort of in the aftermath of the global financial crisis when they increased. So if we're at an inflection point, that can provide a lot of tailwinds in terms of cap rate compression, giving a boost to property valuations again, which is not something that people entering the market, buyers coming off the sideline, have been able to look forward to over the course of the last 2 years, though it's been pretty normal for everyone who's been in the market from 2010 to 2020. So I'm feeling bullish about cap rate stabilization, and at least for the non-distressed, non-class B, class C mall locations, possible cap rate declines in the year to come.
Interesting. Do you see any potential opportunities for development or investment in any geographic areas or maybe urban core while the prices are lower, or are there certain cities that show more promise to you?
I think it's always sort of uh, the pendulum swings, right? So right now, I mentioned that retail property prices in urban locations are down compared to pre-pandemic and lower than a lot of other locations. As you mentioned, that creates an opportunity in a way because if something's cheap enough, you can make it work. And I know we're not talking about office on this show, but I think office prices are getting cheap enough for people to begin to make the numbers work to a certain degree. So uh, I think that where you have strong demographic influx and enough spending, then you can make urban locations work just fine for retail if you can get into the right property prices. I think that's happening in a lot of places in the Sun Belt. You've had a big demographic influx, and I think that even though we're maybe a little overbuilt in terms of apartment supply, people are still moving there. People are still moving to locations in the Midwest. I'm based in LA. We're not a destination for new population here. People have been kind of leaving the state a little bit. So I think that the decline in prices in retail locations and the decline in prices for urban locations for urban retail could present an opportunity going forward in locations where you have in cities where you have a lot of new in migration from across the country.
Yeah, yeah. Well, good point. Um, and I suppose that new development, if it's new supply has really slowed down. You said it's been slow for years, and I assume it's really slowing down in every sector since the interest rates started rapidly rising. I guess if you started a new project today, with entitlements and things and construction, maybe you come out of the ground maybe in 2 years or maybe less or longer, depending on municipality, right? I guess is new supply, new construction, an opportunity moving forward, possibly?
I think probably because usually when something becomes in too tight a supply and it becomes profitable, like we've been talking about, because you can get in at a good price and that drives a lot of your returns, that brings more people to market in order to deliver more supply of that asset. I mean, it's exactly what happened in the multifamily market in the pandemic. Demand for housing surged. There was limited supply to go around. So in the places where people were moving to, you had lots of new construction begin. So I think in the case of retail, you will probably see that dynamic play out a little bit in the course of the next 2 years, where there is demand, where prices have been maybe stable or down a little bit. Um, you will have more investors entering the market, and where prices have been up and where there's a lot of spending, I think you'll see a drive to create new retail space in those locations.
And of course, a lot of the listeners around the country and viewers do have different sides of the deal, the transactions, if you will. And there's a lot of them who really like these down markets to go out there and acquire properties. And we sell a lot of properties for banks and lenders, especially around the southeast. And we've been selling a lot of office properties, and we've sold even one industrial. But we've only gotten one retail property, and it was just a user who failed on a business. It wasn't really an income property. Do you expect much distress opportunities for investors or distress challenges for borrowers in the retail world moving forward?
Yes, but I think it's going to be more concentrated in shopping malls because that's the sub asset class of retail that's really been struggling the most. I don't see a lot of signs in distress in retail outside of that sub asset class. I mean, delinquency rates for retail CMBS have been elevated, but this goes back again pre-pandemic, and they've come down a little bit actually since the pandemic started, but they're kind of about where they are. So I know that I know some investors who are actually almost upset that interest rates are beginning to come back down
Yeah.
because the dislocation in the markets is ending. So
Right.
their ability to, get an off-market deal at a steep discount because some large company is maybe going through a strategic review that is less focused on one particular property, those opportunities might become fewer and far between. I think that there will be plenty of opportunities for creative investors to make use of the mall space that is going underutilized right now. I mentioned I was in the Midwest recently, and I walked through a really beautiful interior former shopping mall. It had since been kind of converted into mixed use. There were some offices, there were still some shops, but most of the shops were all shuttered. But it was a beautiful interior building, and it was an
Mhm.
old classic sort of style property. And so I can't imagine that space going unused forever. It's just a matter of, if people aren't going to be going out to buy goods, then you got to put businesses in there that bring them out. And I do think that people still want to spend on experiences. So if you're a clever investor and you know how to convert space to new uses, or you know how to rehab and add value to a location that maybe needs a little TLC, I think there will be distressed opportunities. But I think probably part of the reason you're not seeing a lot of retail transactions is because if you own a good property right now in the retail space, why sell it? Things you have tailwinds behind you.
Yeah, yeah, well, good point. And when the retail properties doing so well, you don't expect to have as much distress. Of course, some of it's financing, right? Some of that, I guess, will happen if they're paying 3% and have to refinance it at 6. It could cause some problems for some folks, right? Well, Xander, what would you leave our audience with to think about for retail and retail real estate moving forward?
I'd say keep your eye on the strength of the consumer. I think so far it looks all right. I think that there are some signs that they face headwinds. And certainly that stock of savings that we all kind of accumulated during quarantine has now been fully depleted, and we don't have that money to spend. So I'd say keep your eye on the strength of the consumer. And then, secondly, keep your eye on retail properties that might be underperforming, like malls, for example, because as we've discussed, oftentimes distress is an opportunity, right? It's two ends of the same coin. One man's trash is another man's treasure if you know how to turn the trash into treasure. So I think that there will be a lot of opportunities to come out of that subsegment of retail. But generally, I'd say look at leasing spreads. If you see that they're shrinking in the year to come, that would probably be a sign that the headwinds that consumer face are beginning to impact the leasing supply and demand fundamentals within retail.
Yeah. All right. Well, good tips and great information as usual. Xander, thanks for joining us. We appreciate it.
It was a pleasure. Good chatting with you, Michael.
All right. And if you'd like more information from Xander Snyder, he's the senior commercial real estate economist with First American Economics. You can check them out. Their website's firstam.com/economics. They have a podcast, they have articles, and of course, everybody knows First American Title for their title services. So check them out. Hey, if I can help you, if you have any questions, if you need a professional anywhere in the country for any type of commercial real estate activity, let me know. Reach out to me. I'll get you with the right folks. My email's an easy one. It's michael@bullrealty.com. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.